Hi, it's Darren Mitchell from Control and Compound. We have exciting news. October 29th in Vaughan, I want to participate in the Everyday Investor Summit. We're going to teach you 7 proven strategies with 7 different speakers, experts in the real estate world, on how to grow that passive income. Your money's working for you while you're not working. Check out the event, check out the speakers. In-person event in Vaughan, October 29th. You don't want to miss it. In this episode, we're going to compare a tax-free savings account to a whole life. What are the pros, what are the cons, and which one should you have? Hi, everyone. Welcome to Control and Compound with Darren Mitchell. I'm your host, and joining me as always, Christina Wyatt. Christina, how you doing today?
Hi, Darren. I'm doing great. How are you doing?
I'm doing fantastic. This topic we got a couple questions from listeners on, so thanks for the feedback. So we thought we'd do a whole episode on it.
Yeah, excited. But before we get started, I'm going to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. If you're listening or watching on YouTube, please make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on TikTok and Instagram.
Okay, Christina. So we'll do a quick kind of overview of a tax-free savings account, and then we can talk about whole life and then the comparisons. But TFSA or tax-free savings account, it's after-tax money that goes in. So not like not an RSP, you get a tax deferral. With a TFSA, you're paying the tax on your income, and then you're taking that after-tax money, you're putting it in. It grows tax-free. You can take it out tax-free, and when you die, it's tax-free. Sound familiar,
Yeah.
right? So,
Yeah.
very, very similar to the whole life. Now, the options for investing in a tax-free savings account are pretty much the same as an RSP. So you're very restricted. You can have stocks, and you can have bonds, you can have ETFs, but there's a restricted list on what you can invest in. You can't invest in your own real estate, your own business. You can't do any of that stuff. So you're restricted on what you can invest in, and a lot of these accounts are in high interest savings accounts, and up till last year, it's been like 0, 1, and 2% because that term savings, right? I always thought it should have been called tax-free investing account, not tax-free savings account. But you see a lot of people, I mean, a couple of years ago, a lot of people like 1% GICs inside their TFSA, and I'm like, all right, you're saving tax, I guess, but like how much tax are you really saving? And then you're limited on how much you can put in. So, Christina, can you just kind of give us how much can we contribute? And then if we haven't contributed, how much can we contribute? How's the contribution room changed through the years?
Yeah, so with these plans, there are maximum contributions that you can make each year. The plans are fairly new. They've only been around since 2009, these tax-free accounts. And each year, the government announces how much they're going to allow you to put in. So the first year, back in 2009, they let everybody anybody over the legal age put in $5,000. Each year, they have decided what that amount's going to be. And right up until last year, when they announced that for 2023, we could put in $6,500. So if you were of the legal age back in 2009, you would now have an accumulated, because each year, if you don't use it, any room unused is going to accumulate for you. So right now, if you hadn't contributed to a TFSA at all, you could put a maximum of $88,000 in. And you're maxed out. You can't put any more. Next year, they will say, okay, 2024, we're going to allow you, well, we'll see what they say. And typically, they have been telling us they're going to allow us that we can put a little bit more in, and then you can start your contribution again next year. So we do have maximums on what they're going to let us put in here.
And that's per spouse. So let's say we had a couple that, they're in their 30s and they've never done a TFSA contribution. They could put $88,000 each into their TFSAs in one lump sum.
Yeah, exactly. So TFSAs are individually owned. So you're going to own them individually. You can set up a successor where your spouse would receive it on your death, which is actually kind of neat. They will let you use your spouse's room. They'll let it carry over if you name them successor and not beneficiary. So that's actually a tip when you're using your TFSAs. Yeah. A couple other differences that I just wanted to point out, which I mentioned, is that legal age, right? So you can't set these up until you become legal age. So 18 in some provinces, 19 in others is when you can officially set this up and start using it. You also can't use them corporately. So unfortunately, there's no TFSA in your corporation. We'd all be using that. So we can't use them corporately. They are personally owned individual plans.
Yeah, and then just back to the 18, 19-year-olds. So some provinces consider you an adult at 18. Other provinces consider you an adult at 19. But the TFSA rules are actually federal. So federally, it's 18, but depending on what province you're in. So kind of a neat thing that I went through myself with family member is if you're 18 in a province like Nova Scotia where legal adult is 19, you can't start a TFSA at 18. But when you turn 19 the following year, you can start a TFSA, but you can also go back and contribute that year, the amount you could have at 18. So you weren't allowed to start it. So technically, if you can't start it in your province till 19, you can really put 2 years of contribution in. So you don't lose that. So you're deferred from starting it, but you don't lose that contribution rate just because you live in a province that doesn't think you're an adult till 19.
Gotcha. That's great. Good to know.
And then some of the costly mistakes for a TFSA, over contributing. That's a big one. People accidentally over contribute, or you get a couple TFSAs and you put too much in. The penalty on that is 1% per month on the over contribution. So let's say you threw in a 20 grand in because you thought you had room and you didn't. They're going to charge you $200 or 1% of that per month. So at the end of the year, that would be a $2,400 expense. So you don't want to do that. You don't want to over contribute. CRA can give you the amount. You can call in or you can go online and figure out your amount. The other one is kind of similar, is when people will do a withdrawal from their TFSA at one institution and then put it into a TFSA at another institution, and they think they're transferring it, but they're really withdrawing and putting it in. Well, that's going to be considered a withdrawal. And if you make a withdrawal, you can't make that contribution, you put that money back in until the next year. So if you take it out of one institution, you put it in another one, and you're at your max TFSA, they're going to ding you for the over contribution on that. So you got to be really careful there. You can't contribute while you're living outside of Canada. So if you're going to go away for a couple of years to work, you can't contribute. And then the prohibited investments, and this is the one that really I think is important. You cannot invest in your business. You cannot invest in yourself, and you can't invest in real estate. And if you do, there's huge penalties. If you buy your own real estate in there, you're taxed at 50% of the value of investments and 100% of the growth derived from it. So massive penalties. They do not want you to invest in your real estate in a TFSA. TFSA does not mix with your real estate. So there's some of the costly mistakes that we see people do it. And the other one is active trading. So active trading is you can't day trade inside your TFSA. If you make a bunch of trades, buying and selling, they're going to deem that a business, that you're operating a trading business, and they're not going to allow that to be tax-free, and they're going to tax your thing. So you hear sometimes people getting audited and people, TFSAs, having to pay a bunch of tax. Well, government's watching. If you're doing stuff they don't like inside that TFSA, they're tracking everything and they're going to come after you.
Yeah. So couple downsides there that you have to consider. So, we're doing this comparison. Tax-free savings account is a product that we can invest in. And when we do the infinite banking concept, we use the product, the high cash value life insurance policy. So the question is, what's the difference? So I think, highlighting a couple of the points that we just went through and how they are compared, or what's the difference when we're using that high cash value life insurance policy. So just like you said at the very beginning, the high cash value life insurance policy grows tax-free, we spend it tax-free, and when we die, it's tax-free. So very similar, which is why people will be like, oh, well, they both better, they must be the same, right? But that's not actually the case. We've got a couple differences that we wanted to point out. So one of them was that maximum contribution room that we talked about. So each year we get given in the tax-free savings account. Well, with your whole life policy, there is no maximum. Now you create your maximum. So when we set these up, there are maximums, but you decide that. So there is no just $6,000 a year. You can put whatever you want in it. So that's a big difference. We can put a heck of a lot more money in here when we're setting them up. Another big difference is the age limits. So we can only start at 18 in that TFSA. In your whole life policy, we can set up a policy for a child after they've been born 15 days. Now, they're not going to be the owner immediately, but the cool thing is that once they are over the age of majority and you want to give that policy to your child, and transfer it tax-free to them. So you can start that compounding a heck of a lot sooner. And we all know what that can do, right? That compounding for the children. So that's a big difference. Oh, and this one's huge. We can have it corporately. Like that's big.
Huge.
This is the only one out there. This is one of our, as business owners, this is one of the ones we have left. That's a tax efficient vehicle that we can use inside of our corporations, which I think, that's very, very unique in the difference. As a business owner, you're going to be able to utilize this inside your corp.
Yeah. I mean, I think we're leading towards it's a much superior product, but imagine if you could have a TFSA inside your corporation, how many people would be signing up for that? Well, we'll go through the differences, but this is like a TFSA. I think better for various reasons, but we'll talk about. But yeah, it's almost like a corporate TFSA if you have a corporation.
Yeah, exactly. And
almost. No, it's not. I'm not saying it's a TFSA.
And then we get to bring the strategy in, right? So now we get to utilize the infinite banking concept with this product. The TFSA, we can't for a number of reasons. We know that the perfect product for infinite banking is the whole life. And one of the biggest reasons is that and asset, right?
Yeah, absolutely. It's an or asset versus an and asset. So if I put money in a TFSA, do I put money in my TFSA? Or do I go do this real estate? Or do I take advantage of the stock market dropping? Or do I put money in my business? If you do the whole life insurance, you put your money in there, it grows tax-free for the rest of your life, and you can leverage a loan, go do your whatever you want to do, and it doesn't affect your whole life. So your money's in the policy, your money's outside the policy, taking advantage of the opportunity, and your money's providing a death benefit. But if we just kind of step back and say, okay, Christina, we talk about this a lot, like it's not rocket science. If you want to be wealthy, do what the wealthy people do. And we say this over and over and over again. Think of every wealthy person, and I can promise you 99% of them have done one of three things. They invest in yourself. So let's talk about that. You want to join a real estate investing group. You want to hire a coach. You want to take a course on how to be a better real estate investor, or how to be a business owner. You want to go to Tony Robbins to get you pumped up to do more business. You want to take a sales course. You want to go back and take a university degree or a master's in something. Can you use your TFSA for that?
Well, you can, but you're going to be withdrawing from it. So then you're using your cash, right? So you're not actually using your TFSA.
Exactly.
You're now using
your
your
cash out your TFSA to
exactly.
use it.
Yeah.
Versus the whole life, absolutely, you can borrow against it and do that. And then we go, okay, you is the first one. Second one is business. Business is how people become wealthy. One of the biggest ways people become wealthy. Can you use your TFSA and just fire it right into a business without cashing it out?
No, absolutely not. No.
Whole life you can. And then the third one, one of our favorites is real estate. We love real estate. We love real estate investors. We're real estate investors ourselves. Can you use your TFSA on your own real estate to go make a down payment on a fourplex?
No, we cannot. We would again have to withdraw. And I know people listening might say you can invest in real estate to a degree, but it's extremely hands-off, passive, not your real estate, right? But I want to just point that out because you might have people say, yes, there are REITs and stuff that you can. And then people have gotten really strategic in figuring this out. But it's definitely not the same as having your cash in hand to go put down on that duplex, on that multifamily unit, right? Yeah. Not the same.
So if you accept the point of if to be wealthy you need to do three things: invest in yourself, and invest in a business, and invest in real estate. A TFSA does not get you any closer to those three things versus a whole life does. And again, I'm not against TFSA. I think they're great products.
Yeah.
But I'm just saying if you want to be wealthy, you need to be in control of your money, and you need to be in control of your money to take advantage of opportunities, invest in yourself, business, and real estate. And you can't do that with the TFSA. And then again, it all goes back to the fundamentals. What else do rich people do? Well, that compound interest curve where you compound tax-free for the rest of your life, they don't get off that compound interest curve. And we talk about the wealth destroyers, and we got a chapter in my book talk about the wealth destroyer: taxes, fees, volatility, and spending. So the first one, does the TFSA handle the taxes?
Yes, we got a check mark there.
Check mark there. Grows tax-free. Yeah. Take it out tax-free.
We like it. So we do like it for that reason.
So that's
I'm not putting yes.
And
Love that.
That's a big check
Bonus.
for the TFSA.
Yeah.
And then fees. What about fees in a TFSA?
Yeah, they can be high. If you're investing in a mutual fund, you're usually around 2% or so, 2.2%, depending on what you're investing in, but you're definitely going to see some fees in there for sure.
100%, which, again, you can buy your own individual stocks, you can buy cheaper ones, but on average, most people are paying 2.2% buying a mutual fund in there versus the whole life. What's your investment the investment expenses on a typical whole life, somewhere 0.14, 16, 18, 0 point, 20, 30 times lower.
Lower. Yeah.
And again, federally mandated that the fees are low versus a TFSA. It's whatever fee they want to charge, they can charge. So taxes, fees, and then volatility. Can TFSA drop 20 or 30%?
Yes, I've seen it.
Yes.
Yeah. The answer is yes.
Again, if you're in a GIC, no, it's going to drop. But if you're in the stock market where most people end up putting their TFSAs, yeah, you could absolutely, volatility is going to be a concern. And volatility is going to be a very big concern in retirement too when you're taking that income stream. And we'll talk more about that. And then finally, the spending one, right? So if I need to access money to take advantage of an opportunity, real estate, invest myself, business, neighbor's house, whatever it is, if I access that TFSA, I go right back to zero on the compound interest curve. So I'm compounding. It goes back to the snowball, Christine. You take a snowball, you roll it, and then you're going to smash that snowball when you get to cash out your TFSA to take advantage to either go spend on that money you need to spend or the opportunity. Versus the whole life, you can borrow against the cash value and stay on that compound interest curve and continue to grow tax-free. So really, it's that and asset is the key, Christina.
Exactly. We get to use it. Yeah, we get to use it in more than one place at one time. And we've got that compounding, which I think is huge. So I do want to go back to, though, like we've talked about, the TFSA is great, but is good. Like it's great. We utilize them. But it's really building out that foundation too, right? So if we build the foundation, then we can go use our TFSAs as well. So the whole life is going to be the foundation. And then you can and into a TFSA. Like you can do that. And that's, it's just going to complement what you're doing with the tax-free savings account as well. And we've got a couple things like the volatility buffer. That works very well with a TFSA because when you experience that volatility in the market, well, if you've got an uncorrelated asset that you can use, like a whole life policy that doesn't have that volatility, you can really protect your assets you can protect your losing your investments by taking out in a down market, because that is really when you lose in the TFSA, when you've got to take it out. So if you've got something uncorrelated that you can pull from, you're not going to run into that problem. So they do work very well together.
Yeah.
Like they're great together, but your foundation isn't going to be your tax-free savings account, as I think what I'm trying to say here. The foundation's got to be a lot more structured, a lot more control. A lot more control is what the foundation needs to be.
Yeah. Again, big fan of the TFSA. I would rate the TFSA like, as far as government programs go, I'm a fan of the TFSA. But I think to your point is the most important part of your wealth plan is the foundation, just like the foundation of your home. The foundation needs to be rock solid. We don't want that volatility. We want to be in control of that money. And I like the whole life as the first step. And then I really like the TFSA as well. But I think to your point, the foundation should be cash value life insurance. And really, whole life started, 1847 in Canada?
Yes.
So really, we were
the old school TFSA.
Exactly, old school TFSA. It was TFSA before TFSA knew 100 and something years before TFSA existed. And we're going to talk a little bit about the government here. Okay, so TFSA is government controlled. Now, depending upon what you think of government and future governments and future things, like there's a tax-free savings account equivalent in the states. I think it's Roth IRA. Well, not everybody can contribute to that anymore in the States. If you make over a certain amount, you lose the ability to contribute to that. So I don't know what the changes are coming in Canada, but I know maybe none. But I know the government tracks your contributions. The government tracks your balances. Because when these people get audited, when they have too much money in their TFSA and CRA comes in and does the audit, well, how do you think CRA knew they had, $1 million balance and they want to investigate? Because it's all reported to the government. So let's fast forward 20, 30 years. You think we're in debt now. Imagine the debt we're going to be in as a country in 20 or 30 years. The government really is one place to access money, and it's from taxpayers. So could they look at down the road saying, anyone with a TFSA over X or an income over Y, it's now going to be partially taxable or taxable. Or maybe if you need to go into a long-term care facility, we're going to look at your assets inside your TFSA. Or maybe if you're eligible for some government health plans, it's going to be a function of your net worth, and we're going to look at your TFSA. They're going to come after the golden rule, right? They're going to come after the people with money when they need more money. They're not going to come after the poor people. They're going to come after the people with money. Government control on the TFSA, no government control on the cash value life insurance. They don't know how many policies are out there. They don't track it. There's no reporting. You could have 10 insurance policies and the CRA has no idea. So again, not saying it's going to happen, but if you're in your 30s and 40s and you're talking the next 50 years of your life, do you think the government may change some rules during that next 40 or 50 years?
Yeah, well, we only saw this product arrive in 2009, so it hasn't even been around all that long either. And that was a rule change. It was a rule change that they made to allow for this product in the first place. So it wouldn't be too surprising to me that they've changed their minds. They've done that a few times in the past, right?
Yeah. So if you were, if you were saving money, absolutely love cash value whole life, right? Maybe I'm biased, but I've seen it work so successfully through the years. I've seen people use it and just it's life changing. I love whole life. I really like a TFSA. So RRSP, I'm not as big a fan on, especially for business owners and real estate investors. I'm really not a fan, actually, for business owners and real estate investors. So, Christina, sometimes, I call RRSPs maximum security prison, right? It's like, if you put your money in the RRSP, it's in maximum security prison. Now, maybe that's a bit of extreme, but that's my thinking. I look at a TFSA like minimum security prison, right? You're still kind of government controlled there. If you have volatility, it's still going to be tough to take it out if you're down 30 or 40%. But it's much better to me than the RRSP. So I would start whole life first, then TFSA, and then back to whole life and back to TFSA and back to whole life and back to TFSA.
The one other thing I wanted to mention was when you're talking, 40 years out and retirement side of things is sometimes people think short term versus long term. And you really should be thinking long term when you're looking at, your lifelong savings, which is why we do uninterrupted compounding for life. And that brings me to retirement and income streams. Right? So when we're withdrawing from these products, what does that look like when we hit retirement? Now, we know that we can both take them tax-free, but what happens with the tax-free savings account as the TFSA, as you're withdrawing, well, your assets are reducing, right? So every year you take from that account, your assets are going to reduce and you're going to earn a smaller return. Well, on the other side with our high cash value life insurance policy, we're borrowing against it, right? We're never withdrawing from our policy. We don't want to withdraw from our policy. We want it to continue compounding. So if our money is still compounding inside of the policy and we're still receiving these very high returns, our income is going to be much greater than the asset that's reducing, right? We're still going to see that growth happening on our side. And we forgot to say we have a death benefit with ours, like a really big one. I forgot about that, but that's always there too.
Oh yeah, it's life insurance. That's right. It's life insurance.
Right. It's life insurance.
Absolutely. That's game changing. That huge death benefit. I love that retirement analogy, Christina, because people love when we show them how this works in retirement. It's like you have $1 million, I don't know, at 65, and then you start accessing loans, and then all of a sudden you have $2 million, you have $3 million, because you're continuing to grow up. Versus $1 million in your TFSA, you're gonna have 900, 800, 700. So the growth is less. But yeah, the death benefit to me is so huge because legacy, multi-generational planning. I mean, if you could have a TFSA with or without a death benefit, why would you pick one without?
Yep.
Really, in my view. But that death benefit, we talk about this in another episode. It's like a permission slip to spend other money too, right? So the cash value life insurance can make the TFSA way better from a volatility standpoint. We talked about the volatility buffer, and check that episode out if you haven't. But then the second thing, when you have that massive death benefit, well, maybe I'll get a leverage my real estate income properties big time in near retirement, or line of credit against my house, tax-free money, knowing I have this big death benefit to pay it all off.
Yeah, absolutely. So really just like we say, we love the we love our whole life policies. We like our tax-free savings accounts, and they really just go better together. But you just have to know where to start. You want to start with your foundation. You want to build out the foundation of your plan, and then you want to add those other things. But if you're investing in anything that can go into TFSA, absolutely use it. Just, start your whole life policy first, then use your TFSA, and really do utilize it, because I do hear a lot of people that have non-registered accounts and no tax-free savings account. And I'm like, oh no, like you need utilize your TFSA room first. Obviously, get your whole life policy, grow out your wealth, build that foundation. And then if you want to go invest in the stock market, all of those things, utilize all of that TFSA room that you can, because why pay tax on it when you don't have to, right?
Yeah. And then, Christina, we're starting to wrap up here, but let's just talk about this one last thing. When does a deal of a lifetime happen? I love when you say this. I love when you explain to clients, deal of a lifetime. Why does it happen?
Somebody needs money. Always.
Somebody needs money.
Yeah.
Somebody needs money. Somebody has money. That's why the deal of a lifetime happens. So let's look back at 2008, what happened in 2008, which may happen again in 2023 or 2024, right? What happened in 2008? Stock market's down 30 or 40%. Real estate plummeted, especially in the States, but everywhere. Real estate plummeted, and the banks stopped lending money. There were so many deals of a lifetime happening in 2008. People that had access to money were able to buy everything on sale. Massive sales. Real estate was on sale. The stock market was on sale. Businesses were on sale. Everybody had no money, had no access to money. If 2008 happens again, do you want to have your money in a TFSA or an RSP when it's down 20 or 30%? Or do you want to have your money in an uncorrelated asset that's guaranteed not to go down? Because I'm planning for the next 2008 to be incredible deals of a lifetime. I'm building up my cash value. I know that's uncorrelated. I know when everything else drops, my cash value won't. And then I want to take advantage of some of those deals of a lifetime.
Absolutely.
Awesome. Well, that's TFSA versus Whole Life. We love them both. We love Whole Life more, but TFSA is a great product as well. Hope you enjoyed it. Thanks for watching. Thanks for listening. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.